Hey everybody, Rich Krafchick, and I want to get a message out to you. I found myself having a conversation over the last few weeks, and it's been often enough that I thought it'd be useful to just share. So, people call in, I end up talking about the markets on a regular basis, but in light of the recent official start to a bear market, I want to speak on that. So first, the media or market commentators label a bear market as a 20% drop. So, we were down 19, it wasn't officially a bear market, it goes to 20, boom, we have a bear market on our hands. So in our office, we don't get too euphoric during positive trending markets and at all-time highs. We're not overly positive. And at the same time, when there are downturns in the market, we don't let that get us too pessimistic, too anxious, or too panicky. It's the same business for us. We're trying to make smart decisions, weigh opportunities against risks, and continue to manage the portfolio. So I'll tell you that I end up getting calls across the spectrum. Some people are saying, is this a good time to add capital to the market? And I always respect the composure it takes to ask that question. And on the other end of the spectrum, we have people saying, do we need to be more defensive? And I respect that question as well, because depending on where people are at in their personal timeline, it can be quite unnerving to see statements get lower. So what I want to do is share some data with you. And this is what we use in our office. It's one of the tools we use to help us make smart decisions, whether markets are smooth or chaotic or somewhere in between. So let's take a look at this chart. We're looking at a chart that shows the S&P 500. First, let's acknowledge our bear in the background. We are tracking 20% declines in the S&P 500. And since World War II, we've had 12 of those, plus the 13th that we're currently experiencing now. We've marked these with a red triangle. And 1 year after the start of the bear market, we've placed a green square on this chart. And if you notice, in 9 of the 12 since World War II, the market has been higher 1 year after the start of that bear market. All right, now this is the visual aid. Let's dive into the numbers a bit more. Now, as I put this chart on the screen, keep in mind we're going to have gains, we're going to have losses. 9 out of 12 scenarios were positive within 1 year. We're going to have losses still, though, in the other cases, right? So 3 out of the 12 did have losses. And if this was easy, everybody would invest. And you're a seasoned investor, or if you're thinking about investing and you're watching this, just realize this is not a straight line. The market goes up, the market does go down. There's a number of reasons why that happens. And it's not always easy emotionally. But we want to be disciplined, be able to weather the emotional impacts so we can make sound decisions. Now let's take a look at this chart. The first column shows the dates that the bear market began. The second column shows the return of the S&P 500 1 year later. The third column shows the return on the S&P 500 over the following 2 years from the start of the bear market. Over 1 year, the average return was over 16%. Over 2 years, the average across these 12 previous bear markets is over 29%. So if we can stay calm, stay rational, and avoid the initial reaction that fear sometimes leads us to feel, then staying invested makes a lot of sense. This is why we do planning in addition to portfolio management and make sure to have the right blend of risk for your situation. So whether you have a long way towards retirement, or whether you're in retirement, having that appropriate blend is key. We work with our clients to ensure this, and we're in a good spot to weather this storm and see what 1 year and 2 year numbers will look like in this 13th bear market. All right, hopefully this helps to just give you some perspective what we're doing here in our office, and if you have additional questions, feel free to reach out to our team.